Right, accounting for receivables. That's the next in series of the topics relating to receivables. So basically, receivables are the credit customers to who the business sells goods on credit basis, with the understanding that these customers will eventually pay us in future on their due dates. And if they do not pay on the due dates, then that actually creates the risk in the mind of the seller, that why the customer did not pay. So a number of reasons were discussed, that the customer was declared bankrupt, or the customer genuinely did not have any money, the customer died, or customer disappeared, or there was a dispute between the seller and the buyer, and for so many other host of things, the customer did not pay. Right? So now, as far as the risk involving the receivables, whenever you sell goods on credit basis, there is always a risk, whether the customer will pay or customer will not pay. So as far as the risk against credit sales is concerned, that's why many people don't prefer to sell goods on credit basis. They prefer to sell goods on cash basis, because there is a risk which is actually encircling the credit sales, credibility of the customers. So there are two types of risks. Okay. First risk, which are genuine reasons, like the customer died and the customer did not leave any money behind, so we cannot collect. Or the customer genuinely gone into financial crisis and the customer could not pay. So that's, we can say, when the business knows for sure, certainty, 100% certainty, that customer will not make the payment for credit sales. Okay, we sold the goods already, but the customer now anymore, customer will not make the payment. Then we have to record this as a loss, you can say, or more accurately, expense. Okay, more accurately, I'm repeating, more accurately, expense. It's a business loss, and the losses are recognized in form of expenses. Okay, now you might have discussed accounting principle called as accruals. So based upon accruals principle, we must have to record this transaction soon as we will find out that the customer is not going to make the payment. Then we will have to record this expense. Okay, are you okay about this? Okay, brilliant. Right. So that's as per accruals. How it will be recorded, I'll show you. Now, secondly, when business is not sure, when the business is not sure or certain, business is not sure whether the customer will pay or will not pay, whether they will make the payment or they will not make the payment. There is no 100% certainty. Customer says the customer will pay, but the customer has missed so many deadlines already. We are not sure whether the customer is just making lame excuses, or customer is just telling us lies, or customer is genuine. We don't know. So when the business doesn't know for certainty whether the customer will pay or will not pay, this has to be recorded in accounts or financial statements as an expected expense. This hasn't happened, but we will record it as an expense, like it may happen. Okay, and this is in relevance to the prudence concept, that all future risks must be revealed to the shareholders in form of financial statements. So the prudence says all future risks and losses must be recorded, whereas accruals and matching say that we only record what has happened. Okay, so this is what you need to remind yourself. Now, as far as the confirmed risk is concerned, when 100% guarantee that now the customer will not pay, we call this customer as, in the old terminology, we used to call it as bad debt. We don't call people bad anymore because now we are more civilized, I suppose. We don't call them bad debt. Now, instead of calling them bad debt, we call them irrecoverable debt. Okay, and both are expenses. So either you call it bad debt expense or you call it irrecoverable debt expense. Okay, right? But different authors in different parts of the world, they name them in a different way. Again, at the end of the day, you need to make sure that your understanding is clear. Whatever the name or term you give it to this, idea is simply this, that we found out that customer will not make the payment. As simple as that. So you call it bad debt expense or you call it irrecoverable debt expense, doesn't really matter. Okay, long as you know the meaning of this. Okay, now how it is recorded. So soon as we find out that the customer will not pay, we debit something. What do we debit? Well, you know that expenses are always debited. So we debit bad debt expense, or actually irrecoverable expense, irrecoverable debt expense, we debit. And what do we credit? We credit the accounts receivable. Okay, or you can call it trade receivable account. Okay, and this process is defined as writing off of a receivable. So what is writing off of receivable? Writing off, do you know the meaning of write off? Oh yeah, of course, you know a lot more than I do. Writing off is like eliminating or removing a credit customer from books of accounts. That as the customer has died or the customer will not pay, so we are removing the customer, believing that the customer will not pay. So this has become our expense. So we debit bad debt expense and credit the accounts receivable. This is basically based upon accruals principle. Whereas when we are not sure whether the customer will pay or not pay, we cannot remove the customer from the accounting books. So we cannot write off the customer from the books of accounts. So what we do instead, we debit the same thing, bad debt expense, or you can call it irrecoverable debt expense. Actually, in some books I've seen some accountants call them as doubtful debt expense. That we are doubtful. We don't know whether the customer will pay or customer will not pay. So in order to reflect that understanding, some accountants call it doubtful debt expense. So they debit doubtful debt expense, and instead of crediting the account receivable, because we don't want to remove receivable from the accounting books, the customer may pay us. What we do is we credit allowance for receivables, or in slightly older terminology, which is still applicable for so many businesses, allowance for receivables or provision for bad debts. That maybe they are not bad now, but they may become bad in future. Okay. So that's based upon the prudence concept. So I think that short session is enough here. Make sure decode it, understand it, download it or whatever, read something about it. And if there are any issues, you can present in the comments. Thank you.